is the closing bell at the New York Stock Exchange. Not the strongest close of the week for the U.S. stock market. The Dow Jones dropped, about 151 points.
And the S&P and NASDAQ also ended the day in negative territory. Both fell about half a percentage point. Joining us now is J.D. Durkin. He's the host of the financial news website TheStreet. And also joining with us, Jacob Bogage. He's a business reporter for the Washington Post. Thanks, both of you, for joining us. J.D., I want to start with you. First off, several big banks reported a rise in profits in their first quarter earnings today. How did that drive the stock market?
Well, look, we had solid earnings, solid revenue growth for a lot of the big banking names that reported today. And I think that was pretty indicative of how those individual stocks traded. I should caution just the individual stocks. JP Morgan Chase finishing the day up over 7%. A similar story for Citigroup, up about 4.7%. Out of the 11 sectors in the S&P 500 we most closely follow, financials is one of those, and so that was actually the strongest performer in today's session. But I think the challenge overall for the markets is that today seemed to be yet another day where the markets are realizing the economy is slowing down. The data is telling us that as well. We heard from Fed officials earlier this week who are now projecting, not just warning, but projecting of a mild recession later on this year. And we know the central bank is committed to its higher for longer rate hike campaigns. Next week's earnings are going to give us much more of a sort of overall picture in terms of deposits, in terms of the state of credit card uses, in terms of personal savings accounts. On Monday, we'll hear from Charles Schwab. Tuesday, Bank of America. On Wednesday, earnings from Morgan Stanley. And Thursday, American Express as well. So a bit of movements off the information we got today, but this next week will really give us a much fuller photo, or a much fuller picture, rather, about how the state of financials are doing.
So, Jacob, do these earnings indicate that the U.S. banking system is stable on the heels of Silicon Valley and Signature Bank's collapses earlier this year, or is it too soon to say?
It's too soon to say, but it's certainly a step in the right direction. A lot of what we need to know about the strength of the banking sector, we don't have a lot of hard data on that. Probably our leading indicator is how they did reporting earnings and also looking at the inflows and outflows from the past quarter. Those were a little bit tilted toward the outflow side more than investors would like and more than banking executives would like. But still, for now, from what we can see, relatively stable, especially among the bigger banks.
So, JD, the elephant in the room is inflation. And the latest producer price index and consumer price index reports were released this week, and they both showed that inflation is cooling. How are investors reacting to that?
I would put a yes, it's cooling, but I would put a little bit of an asterisk there because you're right. Overall inflation is down. I think it's now down to 5% for the month of March. That's the lowest level we've seen in 2 years. But arguably more important is core CPI. You strip away some of the very volatile elements of things like food and energy. And unfortunately, those are trending the wrong directions. I think especially if you're the central bank, you would like to see the elements of cooling. But the sort of better read or the deeper read of inflation is telling us, specifically in the services part of the economy, their prices are going high, right? So you've got goods and services. Goods, basically anything you spend money on, like this TV remote or this pen that you get a physical good in exchange for. Services or things like haircuts and manicures, and especially restaurants right now. That's what the data is telling us. Americans right now seem to be kind of used to higher prices, and they're shrugging off those higher prices. So if you used to take your family of four out to your favorite Italian restaurant pre-pandemic and maybe that meal came to $90, that same meal today may be $115, but the data tells us Americans are still spending. So I'd say anecdotally, there was certainly a fair bit of positive or encouraging inflation data, but I think there's a reason we heard from so many Fed officials the last couple of days to say, let's kind of cool our horses a little bit here, folks, Americans far and wide. There is progress, but there's a lot more work left to be done.
So to follow up on that, Jacob, let me ask you, prices are still above average. What do these latest reports actually mean for the Federal Reserve and future interest rate decisions?
The Federal Reserve, and we learned this from the last rate hike, is big on symbolism. It didn't want to pull back its tightening regime after we saw the trouble at Silicon Valley Bank, specifically because it was worried about the signal that would send about the state of the banking sector, but also because inflation remains high. Yes, we've seen some wage gains during the pandemic. Yes, we have very low unemployment still. And yes, like JD just said, it's a great point. Americans are starting to get used to higher prices on certain things. But inflation at 5% and core inflation even higher is still unsustainable for this economy, especially as it starts slowing down and the labor market starts loosening. So in terms of what that means for rates, I'd expect the Fed to stay the course at this point and keep tightening.
Jacob, you mentioned unemployment. I want to ask, the Labor Department announced yesterday first-time unemployment claims rose slightly for the week ending April 8th. So, Jacob, what does that say to us about the state of the economy? Is this a sign that the labor market is maybe getting a little more in line with Fed expectations?
It is and it isn't. First-time unemployment claims at this point ticking up. Yes, the labor market's loosening and it certainly needs that. 3.5% unemployment is incredibly tight. But I also think you have to look at where these first-time claims are coming, and a big lump of them came from California. And what can we deduce from that? It's coming from tech, which we've seen slowing down. It's coming from finance, which we've seen slowing down. We need to see that start to trickle into the rest of the economy, especially the goods-producing sectors, before we start making broader conclusions about where the labor market's heading.
All right, JD, let's switch gears. Burger King's Whopper sales have reportedly exploded in the 7 months after the restaurant chain unveiled a new strategy to revive its U.S. business. Now, has this success been reflected in the markets even before Burger King releases its first quarter earnings next month?
Well, it's a $400 million turnaround strategy aimed at increasing same-store sales. To the point about the markets, I think the ticker symbol worth noting, QSR. That's for Restaurant Brands International, the parent company there at Burger King. I will say, anecdotally speaking, as a football fan, a lot of us sat there during the NFL playoffs. You're on the edge of your seat because your team is down late in the fourth quarter, and suddenly, yes, exactly, that's the sound that you hear. It goes to commercial, and suddenly it's like, Whopper, Whopper. And I was like, I only care about the New York Giants right now, but now the Whopper song is stuck in my head. It is undoubtedly a viral success. It was all over social media, went viral on TikToks. Remixes of it then went viral on other TikToks as well. The last quarter, Burger King's same-store sales in the U.S. did go up 5%, but to your point, on May 2nd, we'll get that latest earnings report. In between now and then, I'm sure none of us will be able to get that song out of our heads.
Yeah, I'm with you. Earworm, totally earworm. All right, JD Durkin and Jacob Bogage, thanks to you both. Really appreciate it.
So long.
Thank you.